Hey everyone, it's September 22nd, 2013. Before we jump into this week's content, I want to point out that I won't be making a weekly video until the 3rd, possibly extending to the first week of November. In other words, this is the last weekly video I'll make for the next 3 to 4 weeks. Next week I'm going on vacation, much needed vacation, and the following weeks after that I have to attend other matters. So because of that, I won't have the time to make these videos. As most of you know, I spend a great deal of time analyzing, interpreting, and assessing market conditions before I actually make these videos. It's not as though I just begin to babble or share my opinions with you without formally conducting some sort of analysis. This is part of the analysis I do on a day-to-day and week-to-week basis. So part of what I do each day, I'm sharing with you through these weekly videos. Granted, I don't share all information, but the most information that I possibly can, I do share. So until then, I just want to let you know that I won't be making these weekly videos. Let's quickly jump into the charts. I'll try to make this as short as I can without going without making this video 30 minutes long as I've done in recent weeks. I'll try to keep it under 15 minutes. So for the S&P 500, I mentioned last week how 1948, the biggest risk or the most glaring observation right now is this head and shoulders formation forming on the weekly and monthly timeframes. There was a research note this morning by HSBC where the strategist basically concluded that the current top being formed in the S&P 500 is bigger or broader than the top formed in 2008. By contrast, there was another research note by Goldman Sachs reaffirming their 2100 price target in the S&P 500 through year end. This echoes the price target by Deutsche Bank and a few other firms. So these contradictory research notes or remarks, whatever you want to call them, are only broadening, or I should rather say, they're only adding to the confusion and level of anxiety in the marketplace. Markets, as they are, they're very confused as to whether we're going to break lower or possibly contest the former highs, and from there on out trade out higher. Part, at least in my eyes, part of what the Fed event should have done, should have essentially quelled market anxiety and laid out a path of future rate hikes. What matters, and I've said this a million times, is not when and if the Federal Reserve moves rates by 0.25%. That's a given. That's a fact. The Federal Reserve will hike interest rates, be it in December, in the first, or even in the second quarter of 2016. It's a given. And believe it or not, markets have already discounted part of that rate hike. So that's a given. That's a fact. That's an event that, even though it hasn't technically taken shape, it's already been discounted in the market to a large degree. What matters more is, again, and what investors, I think, will pay close attention to, is the path or the trajectory of future rate hikes. So again, if they wanted to quell some of this anxiety, they would have, at the very least, even if they decided not to move, lay out a time frame of when some of these expected rate hikes would occur. If the goal, on the other hand, or the objective was to keep anxiety high for whatever reason, then they did a superb job. I'll just leave it at that. But the fact that more and not less anxiety is palpable in today's markets. Not by the added risk, because essentially the Fed removed that element of risk, at least that risk of possible contagion. The possible contagion that's currently being manifested in emerging markets, being spilled over to U.S. equities and other parts of the advanced world. But they eliminated that risk by essentially prolonging a rate hike. But still, there's this element of confusion among investors about what markets will do. And that's just adding to the level of frustration by investors, and it's only going to discourage market participation. Again, if the goal was to discourage market participation at a critical junction of the market, then they did an amazing job. If, on the other hand, their job was to induce market participation and get people, especially retail investors, in the market, then I think they failed terribly. And that's not going to change. That perception is not going to change, I fear, until not only there's a short-term trend established, but until the S&P contests or breaks two new all-time highs. I mean, that's how badly damaged the market structure or the image has changed. Again, this is a very important aspect to take into consideration and understand because it directly affects not only the way you approach markets, hopefully, but the way other people will approach markets. But for the S&P 500, the downside targets, and I said this a million times, are the October 2014 lows at 1840, followed by the important fib retracement at 1780, and from there you have basically nothing but air down to 1660 to 1680 on the S&P 500. The high probability trade is a break below 1780 down to 1660 to 1680. Anything in between is quite frankly, given the high IVs, not worth it. To the upside, you need to establish 1948 on a closing basis, daily closing basis, as a higher low, and then proceed to recontest the current high of the established range at 1994, and more importantly, from there, break out of this current range and again establish the higher low in 1994 and proceed to create a new higher high at 2103. That's on the daily time frame. What you see over here is just simply trend lines. Again, I'm not very fond of trend lines, but I've drawn them because again, many traders use them, and it doesn't really hurt to include them just for argument's sake. The reason I don't use trend lines is because what we have here. Before I give my quick opinion, is that what we have here is the old trend line and the new trend line, and this is exactly part of the reason why I don't use trend lines. What differentiates this trend line from this trend line? Why should I pay more attention to this trend line rather than this trend line? And how is price assimilated through time, either in this trend line or this trend line? In other words, what is so significant about this trend line prior to the breakdown than this trend line? As far as, again, price is represented through time. It just doesn't, there's some gaps as far as the entire conceptualization of a trend line that, again, it's just will lead you to make more rather than less mistakes. So, but nevertheless, these are dominant trend lines a lot of people are focusing in on, and it's something you should focus as well. From a candlestick perspective, this long and large topping tail is problematic, and it speaks to, at least to me, it tells me that markets are not yet ready to trade higher, and they're likely to trade at the very least in this range, let's call it between 1910 and 1994, for at least the next week, possibly extending to 2 weeks before there's a resolution up or down. So that's that. Now, another important observation, and that I think will help you out, is notice that since we got that breakdown on August 24th, of this year, actually, just a month ago, most of the moves the S&P has had have happened overnight. In other words, they've happened in the futures market. It's not as though once we get a notable 20, 30, 40% gap lower in the S&P, it's not as though we've seen a continuation or a carry-through effect on the equity side. So until we see that carry-through effect on the equity side, right, or during regular business hours, it doesn't necessarily have to be on the equity side, it can still be in the futures market, but until we see that sort of carry through during regular business hours, you have to question twice current weakness. That doesn't mean you step in and buy with both hands and both feet, unless you feel extremely comfortable in the stocks you're trading. But it does mean that there's not enough selling, or the selling that already took place is not enough to carry prices lower. Again, that could change if we see continued weakness from here on out. In the S&P 500, where essentially the selling pressure carries over during the regular business hours, it's not just an effect of extended hours trading. So that's the second observation. And the third and final observation is, Ever since 2013, um, each important reversal in the S&P 500 was marked by a hammer or a hammer-like candlestick forming on the weekly. We saw it on March of 2013. We saw a hammer candlestick form, which led to higher prices. We saw it again in June. We saw it again in September of 2013. We saw it again in February of 2014, in October of 2014. Again, these are hammer or hammer-like candlesticks that have essentially pointed to a key reversal before higher prices were achieved. The fact that we haven't established a hammer, and B, failed to see any meaningful or any material upside once this large bullish candlestick was set, again, shows to a change in market perception and sentiment. It doesn't mean we're in a different market cycle. Just because perception and sentiment change doesn't mean there's a new market cycle at hand. It just means market perception changes, which is just as important as understanding in what market cycle we are in. But again, the fact that that hasn't happened this time around reaffirms what I just discussed about the market image or the willingness by market participants not just to bid stocks higher, which is a current prerequisite if the S&P wants to trade it higher, at least through year end, but the fact that less people are willing to participate because of the added confusion level anxiety just shows how badly damaged the image, the market image is today. I mean, you can argue both ways. You can say it's what I'm just talking about is complete fluff. It has no meaning whatsoever, and you might be speaking the truth. But the way I see it, there's too much confusion, and that confusion is quickly forming into anger, which is not at all what we want to see. Or at least market bulls want to see. Market bears are fairly content. For this anger will likely lead people to do stupid things as far as trading or investing is concerned, and that should open the opportunity for a bigger or an outsized move either way. As for other than the S&P setting a new pattern of higher lows and higher highs in the daily time frame, what else needs to take shape? For one, small caps need to lead markets higher if there is going to be any possibility of a move higher. Now, granted, over the last few trading days, the IWM, which is a proxy that tracks the performance of not the S&P 500, the Russell 2000, is actually outperforming the S&P 500. Even though this is a very small gap and doesn't really tell us much, A, because it's a small gap, and B, because it has been persistent enough, it's still something to monitor over the next few days and weeks and see if this gap or this divergence grows in size and in persistence. If it does, then perhaps that will give us an initial hint that markets are in fact ready to turn higher. But again, it will require small caps to trade higher. Another point worth bringing to your attention in the IWM is the fact that one could argue that the IWM is in a downtrend, a short-term downtrend. And if you were to use this trend line as a means to sort of confirm this belief, then you'll probably have some merit, especially because what we've seen is a series of lower highs and lower lows formed as a result of this trend, of this downtrend. This is not particularly the case with the Nasdaq and with the S&P 500 yet, but as time passes on, it will change, and both indices, just as the Russell 2000, will be in a confirmed short-term downtrend, which could add further pressure. So that's an important factor to take into consideration. So what does this trend line mean? It means, well, again, the Russell 2000 is in a short-term downtrend, but second is also leading other indices into this decline. So again, if there's going to be a turn, be it this week, next month, in a year, whatever it may be, it's going to be led again by, or you're going to see that initial move in the Russell 2000 because it's deeper into I guess you could call it corrective cycle, that it's probably going to be the first one to turn if and when it happens. And lastly, what price point should you focus in on going forward? Again, any trade above the midway point to the current range or above the 50% fib retracement to this range, which is 112.40, continues to support the point of an eventual move higher in the index. But it does not in any way guarantee the index is going to trade higher, much less confirm a move higher. It just increases the probability the longer price stays above on an intraday, daily, weekly, and monthly closing basis above 112.40. Again, so that's something very important to take into account. As far as oil, I'm not going to really discuss much because nothing major has changed. We continue to consolidate in this well-defined cup and handle, which as of now is forming a rounded bottom. Oil still needs at least, at the very least, another week before there's any resolution up or down. Again, on the USO, 1424 is the level to watch for to the downside. And to the upside, 16 even. The euro, remember that there's a key directional change coming or leading into the first week of October. So pay close attention to that. We've seen a strong rejection at the 114, 114.15 level against the US dollar. So clearly there's enough supply waiting to be absorbed at those higher prices if the euro were to show some strength going into that directional change date of October 1st. So, if you were to review, excuse me for the lapse, but if you were to review Bank of America's Merrill Lynch asset allocation survey, you will notice that cash levels are at the highest they've been in 5 years, or essentially since 2008. Obviously, this speaks to the confusion, anxiety, and frustration by market participants. Essentially, you're having less people participate in a market that has yet to establish a trend, A, and B, shows no clear conviction of if it wants to move higher or lower. While some of this cash over time, and that's a key word, over time has to be redeployed into equities or into some major asset class, it doesn't have to be put into work right away. So even though high cash levels are long-term predominantly bullish, they're not short-term bullish by any means. And so that's a glaring observation I witnessed or I noticed in the Bank of America Merrill Lynch asset allocation survey. I mean, there were a few other interesting tidbits, but I'm not really gonna discuss them here. So I mean, like I said, I want to keep it short and simple. Not much has changed since I last spoke to you guys about roughly 4 or 5 days ago. And again, I hate to say it, but there's not enough color, as much as I hate to say it, in the markets to really say, no, you know what, this market is going to trade higher because of this and that or whatever. What's ready to trade lower? It's just not enough information. Like I said, there's not much conviction either way. Remember, cash is a position. Fund managers, even though they're paid to perform, remember that cash is still a position and you can still perform and actually perform extremely well holding cash. So just bear that in mind. Continue to respect the price for what it is. Keep a close eye on the IWM. Something else you can keep an eye on, just to give you a heads up, is the spot price of rubber. Rubber is considered a leading economic indicator, and there's a very close correlation between the spot price of rubber and crude oil. So until there's some sort of a bottom in the spot price of rubber, which there hasn't been yet, it's hard to argue against a bottom forming in crude oil. So those are two different vehicles you can sort of assess market conditions and market profiles, if you will. Again, there's a host of other factors and variables that you can take into account and have better understanding of what markets may or may not do short and longer term. I just shared with you a few, so hopefully they'll help you navigate current market conditions. I'll be back towards the end of October into the first week of November. Hopefully by then, not only has market volatility subsided somewhat, which hopefully will lead to more and better opportunities, but also we'll find some sort of a resolution up or down to this range. Because quite frankly, as each day goes by, I myself am getting a little bit more confused and irritated, precisely for the reasons I already mentioned. Stay nimble, stay focused, respect price for what it is. Do not trust markets, and just clear out all the noise that you read, hear, or watch on TV or on the internet, whatever it may be. It's just counterproductive to what we're interested in here. And remember, the best opinion is your own. Even if it's proven wrong sometimes, still stick to what you know, and over time you'll do far better. Hopefully, the Fed doesn't move before or in October. If the Fed does move, then that's certainly going to make up for a very interesting market towards the end of the year. And by the time I make the next weekly video, a lot will most likely change. So we'll see what the Fed does. If it does move, then great. Probably, you'll probably see initial negative knee-jerk reaction. And if it does, I'll probably step aside and wait for that 1660 to 1680 level in the S&P to be contested before there's any attempt of a rally whatsoever. But until then, I will talk to you in about 3 to 4 weeks time. Make sure to check out the blog post, and finally, make sure to also subscribe to the service. I'm in the process of writing the monthly market report, which I will send this afternoon. It's an avenue where I share with you my thoughts, views, and expectations of the broader markets. I share with you different sentiment, price, volume indicators and readings. I share with you what they mean, how you should interpret them, analyze them, assess them, but more importantly, what they're telling us about future market expectations and how we, as a group, should accommodate our trades going forward. Quickly, one of the charts I'm going to discuss in this month's monthly report is the negative performance year on year of every single major asset class over the last year. Essentially, it doesn't matter if you're talking about emerging market stocks, emerging market debt, foreign REITs, domestic REITs, high yield corporate debt, government debt, whatever it may be, even U.S. Treasury inflation protected securities. All of these asset classes, all of them, are down over the last year. Even if it's less than 1%, they're all down. This hasn't happened, and I mentioned this before, but this hasn't happened since 2008. So clearly, a bigger change is afoot. So just be mindful of that. But nevertheless, please join. Remember, just visit the website and click on the subscription link, which will redirect you to the 2 different trading services we currently offer. With that said, I wish you the best of luck. Be extremely cautious, and I'll talk to you in a few weeks.